Hey everyone, welcome back to another dividend investing video. As dividend growth investors, we're looking for companies that have a policy of every year increasing their dividend payment, companies that are increasing their free cash flows year over year, every year. With the month of January 2024 wrapping up, it's time to take a look at some of the notable companies that announced a dividend raise in the month of January. I've picked out 17 of them, so I'm not going to go into deep dives onto any of these, but I want to look at their dividend raise announcements, and I'm going to make some general observations on things I see that are notable. Perhaps this will give you some ideas for your own watch list, and you can let me know down in the comments if there are some of these you'd like to see more of a deeper dive video on. So 17 is a lot to cover. Let's dive in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. And the graphics I'm showing you here are from simplysafedividends.com mostly, as well as the safety scores they provide. I'll show you those to you here. First up, we have Bank OZK, formerly known as Bank of the Ozarks, ticker OZK. This is a regional bank headquartered in Little Rock, Arkansas. For 53 consecutive quarters, the bank has raised its dividend payment. And let's now make that 54 consecutive quarters, with a 2.7% dividend raise announced in January 2nd, bringing the total dividend growth to 13% over the last year. Now, if you decide for yourself you're comfortable investing in these regional banks, this might be a strong candidate if you're a dividend growth investor. Over the last 5 years, we have 12% annual dividend growth, 26 consecutive years without a reduction, which would make them a dividend aristocrat. Although as a mid-cap, they may not technically qualify. This one has already paid out, but I think this is the candidate for the watch list if you're interested in regional banks. Last year, there were far better opportunities to acquire this one, as with most regional banks, so one to keep on the radar, I think. Next up, we have the very popular MLP, Enterprise Products Partners, ticker EPD. They're in the oil and gas storage and transportation industry, feature a hefty dividend yield, about 7.5%. So on January 8th, the midstream operator announced a dividend raise of 3%, bringing it to 25 years of consecutive dividend raises. And this company has been doing biannual raises twice a year, bringing the total dividend growth to 5%. So that interesting mix of income and growth together, but things look reasonably valued from both the dividend yield theory perspective and the price to distributable cash flow, which are both right in line with the 5-year norm. So perhaps a good choice for those looking for income today and that little bit of growth to boot. EPD is going ex-dividend on January 30th, paying out 51.5 cents on February 14th. All right, next we have monthly dividend payer Stag Industrial, ticker STAG. On January 10th, the industrial REIT announced its 12th consecutive annual dividend raise with a 0.7% raise. At the time of publishing, shares are yielding 3.88%, and they pay out monthly, which does attract a lot of investors. That is a cool payout schedule. Get that dividend every month is pretty nice. But that low dividend growth is pretty typical for Stag. That's what they've been doing. One of the reasons I've not really been a buyer of the stock. Not to say that it's a bad investment. It could very well turn out fantastic. But as a dividend growth investment, it's not for me. In terms of timeliness, the yield is 13% below the 5-year average. And the price to AFFO is a little above its 5-year norm, suggesting right now Stag could be in overvalued territory at this time. So I'd probably just avoid this one for now. This is Stag Industrial. Then we have BlackRock Inc., ticker BLK. On January 12th, the world's largest investment manager announced a 2% dividend raise, extending its growth streak to 15 years. That low 2% raise was a bit disappointing, but it's typical for this industry right now, and their payout ratios are edging a little bit on the high side. Shares are yielding 2.59%, and I think shares of BlackRock are in reasonable value territory, fair value territory. Full disclosure, I am a shareholder of BlackRock. Given their dominant place in the markets, I really think this is one of those quote-unquote buy and hold forever dividend stocks, and they feature a dividend score of 98. You have until March 6th to have your shares for the dividend payment on March 22nd of $5.10, and that's BlackRock Inc. Then next on January 17th, Fastenal, ticker FAST, FAST, announced an 11% dividend hike, extending its consecutive dividend streak to 26 years. Fastenal is part of the industrial sector, providing construction supplies such as fasteners like nuts, bolts, screws, studs. That 11% raise, nothing out of the ordinary for Fastenal. Business as usual, right? The annual dividend growth rate for the last 5 years is 13%. Very solid. I think shares are looking reasonably valued. They're yielding about 2.3%. Payout ratios are a tad on the high side. Revenue is steadily rising, consistently high return on invested capital. So I think Fastenal, high quality company. They just replaced Walgreens on the Dividend Aristocrats Index as well. I myself have been in a very similar company called Snap-on. That's where I've been investing, but this is another solid option in that sector, Fastenal. Okay, moving along. On January 18th, New York City's utility giant, Con Ed, ticker ED, announced a 2.5% dividend raise, marking 50 consecutive years of dividend growth, slow but steady and reliable with a Simply Safe dividend safety score of 90. You do have until February 13th to have your shares for the next payment of 83 cents on March 15th, with shares yielding 3.66%. They're pretty close to being in line with their 5-year average in terms of dividend yield theory, and I think shares look reasonably valued for this utility giant. I do think there are better options in the sector for more growth, but this is one of the more reliable, safer companies in that utility sector. Also on the 18th, Valero Energy, ticker VLO, came out with a near 5% dividend hike in addition to extending its buyback program. They're in the oil and gas refinery business. There was a stretch there in 2021 and 2022 when the dividend payment remained flat, so this is just a one-year streak at this point. But prior to the pandemic, this dividend was growing at an impressive clip. Over the last 5 years, the average annual dividend growth rate is 5%. Looking at VLO, the buybacks in particular are quite impressive, going from 530 million shares outstanding in 2014. Today, there are 353 million shares outstanding. And remember, we want that to go. We want those to decline, the shares outstanding. That's a 33% reduction in outstanding shares over the last decade. Now, if you're comfortable investing in this oil sector, energy sector, VLO is not a bad choice, but in terms of timeliness, I do think it is on the overvalued side right now. So maybe better for the watch list right now. That's Valero Energy. All right, then let's look to Canada. That's the Canadian National Railway, ticker CNI. On January 23rd, the Canadian Railroad Company lifted its dividend payment by 7%, achieving 28 straight years of dividend growth, looking solid with its 2% yield and a Simply Safe dividend safety score of 97. Solid growth, both EPS and free cash flow, well-covered dividend, share buybacks, high return on equity, high return on invested capital, solid margins, lots to like about CNI. And I just love investing in the railroads myself. And yes, when I play Monopoly, I go for all four. I love owning those railroads, guys. Have your shares by March 6th, though, for that 84.5-cent dividend payment on March 28th. This is paid in Canadian dollars, so that payment in USD will vary slightly, and that is CNI. Also on the 23rd, S&P Global, ticker SPGI, raised its dividend by 1.1% for its 51st consecutive raise. Yes, 1.1%, disappointing, but like BlackRock, we're seeing slowing dividend growth in this part of the financial industry. Like BlackRock, it's a company heavily ingrained in American Wall Street financial system, and it maintains indexes. In fact, the very popular Dividend ETF, SCHD, is an ETF that tracks S&P Global's U.S. Dividend 100 Index. It's a low-yielding company, below 1%, very safe dividend rating of 99. The 1% raise is a blip in an otherwise impressive streak of dividend growth, with a 5-year average dividend growth rate of 15%. In terms of timeliness, I think we're looking at a company that's a little bit overvalued, but I do believe SPGI is a stock that belongs on your watch list. This is, after all, a company with a 10-year total return of 583%, more than doubling the broader market. It's one hell of a quality company. Moving to the 24th, managed healthcare firm Elevance Health, ticker ELV, hiked its dividend by 10%. It's another lower yielder at 1.34%. Also has a 10-year total return of 563%. So we found another compounder, double-digit dividend growth, rock-solid dividend with the perfect dividend score, growing free cash flows, consistent buybacks, revenue growth, consistently high return on equity and invested capital. This is one of those companies doing all of the things right, and I think they might even be in undervalued territory, at least going by their dividend yield and PE relative to the 5-year norm. Definitely an interesting company. We'll be taking a look at Elevance Health, formerly known as Anthem Blue Cross Blue Shield. More raises announced on the 24th, including Kimberly-Clark, ticker KMB, hygiene product company best known for their Kleenex brand. They are hiking their dividend by 3.4%, marking 52 years of consecutive rising payouts, making Kimberly-Clark a dividend king. Right now, shares are yielding around 4%, and we have a Simply Safe dividend safety score of 88. Not a particularly exciting company, but if you're looking for stable, reliable dividend income, It's not a bad choice to look at right now, with the dividend being 19% above its 5-year average at this time. Not a whole lot in terms of growth, but well-managed business with exceptional return on invested capital, slow but steady growth. If you have your shares by March 7th, you'll get paid on April 2nd in the amount of $1.22 per share. That's Kimberly-Clark. They've been paying uninterrupted dividends for 89 years, so much respect to this dividend king. Although when you look at the last 10 years, we have a total return of 63%. I think of this as a retirement living on income sort of play strictly. All right, then on January 25th, media giant Comcast increased its dividend by nearly 7%, achieving 15 straight years of consecutive dividend growth. Comcast is one I own in our public YouTube portfolio here on the channel. We have a 5-year average dividend growth rate of 9%. If you have your shares by April 2nd, you'll receive the April 24th dividend payment of 31 cents per share. I think shares of Comcast are still attractively valued, even as it is sitting near a 52-week high, with its 2.66% dividend yield being 22% above its 5-year average, and trading at a forward PE of 11, which trades below its 5-year mean, as well as the communications sector as a whole. Payout ratios are low, very safe, dividend safety score of 89, tons to like with Comcast. Then on the 26th, one I would urge some caution on, that's Archer Daniels Midland, ticker ADM. They announced an impressive 11% raise. And I do urge caution just because recently ADM was in the news for the wrong reasons. It dropped over 20% after the company had to fire its CEO and postponed its quarterly earnings report amidst an investigation into some of its accounting. There's a lot of unknowns with that, right? So with these unknowns, I'm not crazy about having a position in a company like this. It could, of course, turn out fine, but we will see. Simply Safe Dividends did lower its safety score from 94 to 80 on this news. This is a company that has paid uninterrupted dividends for 90 years. Likely will just be a short-term blip or setback for Archer Daniels, and could certainly be an opportunity. So let me know down in the comments what are your thoughts on ADM stock right now. It's pretty crazy what's going on with them. Then, on the 26th, we also got word of an impressive dividend raise from consumer finance firm American Express, ticker AXP, when they announced a 17% dividend raise. Now, I love this company, and I do think they deserve a look. 28 years without a dividend reduction. Things remained flat during COVID, as many banks and financial institutions did and often were required to. They have a 5-year average dividend growth rate of 10%. Even though shares are at their 52-week high, they are looking fairly valued right now, shares yielding 1.37%. AXP is heavy into share buybacks. It's really got its debt under control recently. Simply Safe dividend safety score of 80. All around, ton to like with American Express. And another one on the 26th, we have multi-utility company Black Hills, ticker BKH. They announced a 4% dividend raise, marking its 53rd consecutive year of annual dividend growth. These guys provide electric and natural gas to western states such as Colorado, Montana, South Dakota, and Wyoming. Payout ratios are low. Shares today are yielding 5%, making it look way undervalued in terms of dividend yield theory. This is the case with a lot of utilities. You want to have your shares by February 15th to get the 65-cent per share dividend payment on March 1st. They feature a Simply Safe dividend safety score of 77, and it's a utility worth keeping an eye on if you like investing in this sector. Next up was property and casualty insurance firm Cincinnati Financial. This is ticker CINF. They announced their 63rd consecutive dividend raise at 8%. I like it. This is a $17 billion insurance company headquartered in the heartland of Ohio, featuring a 5-year average dividend growth rate of 7%. If you have your shares by March 18th, you'll get their next dividend payment of 81 cents paid out on April 15th. That's 81 cents per share. The company looks undervalued in terms of both dividend yield theory and PE ratio, really liking the steady growth in free cash flow per share with this one. And with a Simply Safe dividend safety score of 71, I think this makes them a dividend king worth keeping on your watch list. Finally, we had quite a disappointing announcement on the 30th about United Parcel Service, ticker UPS, announcing a 0.6% dividend raise. Yes, that's 0.6%, 0.6%, climbing all the way from $1.62 per share to $1.63 per share. UPS is seeing softening shipping volumes, and their labor deal with the Teamsters Union has put a lot of pressure on their profits. They have announced they're laying off workers, and it's going to take a few years, I think, for their business to turn things around. I think they're going to have a rough time. Could this pay off in the long run? I do hope so. I do hold a handful of shares in my Roth account. I'm going to plan to continue holding onto those, but I'm not super bullish on these guys, at least in the short term. Very disappointing outlook and raise. So with 2024, we're definitely seeing lower dividend raises so far, especially in those financial sector, the asset managers. Like T. Rowe Price also came out with one right before I've written the script, and theirs was also very underwhelming. Is this going to continue throughout the year and be a theme? Who knows, but we will have another video at the end of next month about the raises we saw in the month of February, so be sure you're subscribed to stay in that loop. Thank you all so much for your continued support. Can't believe we are a dividend investing community more than 20,000 strong. We could fill a stadium together, all of us. How freaking cool is that? That's all for now, guys. Got to get the portfolio wrap-up video together for the month, so this will be out shortly as well. So until next time, keep investing.